There's this hand technique for assessing a rental property using what I call the Foursquare method. It's nothing groundbreaking, it's just a means for me to visualize a property study so that I can decide if a rental property is worth buying or if I want to ignore it. Welcome to Financial Fluence. In this video, I'll teach you how to use the Foursquare to ascertain a rental property statistics. Let's now get going. We need to decide what goes into the income that has been created. Let's say you have rental income, but rental income will almost certainly be your primary source of income. You might be able to make more money as a supplement if your home contains a laundry space for laundry income and storage for storage income. Let's evaluate a local property. It's a duplex. The picture here is the property we're going to analyze, which is, let's say, $200,000. Since it is a duplex and each unit costs $1,000, multiply it by 2 and that's equal to $2,000. Since this home doesn't have any facilities like laundry rooms or storage space, we'll assume that there won't be any income either. I will assume that the property will bring in a total of $2,000 every month. Now, let's move on to number 2, which talks about the monthly costs of owning a home. Many investors who wish to buy rental property make mistakes because they are trying to buy real estate without computing expenses. There are significantly more expenses than revenue, which is why the income box is smaller than the expense box. You can learn what these are if you're new to this and have no idea what they are by talking to local investors, agents, or whatever. For now, let's say taxes, property insurance, utilities, which include electric, water, sewer, garbage, and maybe gas. After that, we have HOA or Homeowners Association fees, if you have any, then lawn or snow fees. Next, we'll have a vacancy. As we all know, there will be times where this will be vacant. We also have repairs, then what we call capital expenditures, or CapEx, which refers to the process of saving money for significant expenditures, such as new water heaters, appliances, and other large goods. Finally, we have our property management, and then we have our mortgage if you don't pay cash. So those are the most common costs in your area right now. So if you're not sure what your taxes are, go to your tax assessor. If you're not sure what your insurance is, talk to an insurance broker. The more you do this, the more general numbers you'll get. We get $150 a month here. Now, insurance could vary a little bit depending on your place, but I'm going to guess about $100 a month for this property. Finally, utilities can vary depending on whether the tenant or you pay them. For this situation, let's say that the tenants will be the ones who pay the utilities, so that's $0 for us. This property, for example, is not in a HOA area. There will be no HOA fee. And the tenants will also be responsible for maintaining the property's snow and lawn by themselves. So for you, it will also be $0. We must budget for vacancy because the property will be vacant at times. I estimate that 5% of what we're talking about is rental income, which ranges from $100 to $2,000 per month. The next step is repairs. You're aware that you need to make repairs. It is something connected to CapEx. Repairs are if tenants break something, then it should be repaired. And CapEx is for anything that needs to be replaced. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. So typically, what I like to do is see about getting maybe $100 in repairs for this property. Also $100 for CapEx, so in total. Remember, you have to save up for those things. Next, you have property management. We'd already declared that the property was now valued at $2,000. Assumptions are necessary in this situation, so let's say $200 a month for 10%. Lastly, we got a mortgage. There are free and paid mortgage calculators online, so you could check that out. We acquired this property for $200,000, so let's put down some money for this. If I thought the interest rate would be 5% and the loan would be for 30 years, the monthly payment would be $860. Now that we have a list of most, if not all of our expenses, we will add them all up to get our total monthly spending. The total would be $1,610. Now that we have our income and expenses, it's time to move on to box 3. We are mostly interested in cash flow. Fill out boxes 1 and 2 before moving on to box 3 to calculate your cash flow. So 3 is the cash flow. We have to deduct our expenses from our income, and that's $390. Do you think $390 is a good amount per month? We must compare the amount of money we invest to the amount of money we make. This is known as your cash-on-cash return on investment. So we'll write cash on cash return on investment as this is a box for it. Don't be worried by the complex words here. All they actually mean is whether your money is making what kind of proportion of earnings. Finding out how much money we invested in a trade is the first step we take when looking at returns. We can't figure out the return because we don't know how much was invested. We'll total up all the money we invested in the deal to achieve that. We'll start with our down payment, closing costs, rehab budget, and miscellaneous to get our total investment. Total investment is what we are going to write here. Given that the price of the property is $200,000, the down payment would be $40,000 if we paid $200,000 and put down 20%. We still have closing costs on the house we bought, in addition to the down payment. The closing fees in this scenario will be $3,000. The amount of your closing costs will vary depending on the type of loan you apply for in your area, but they will be limited to $3,000 in most cases. Assume we wanted to paint the house after we bought it to make it appear nicer. As a result, we expect rehab to cost roughly $7,000. In this example, we spent $40,000 on a down payment, $3,000 on closing fees, $7,000 on rehab, and $0 on miscellaneous. That's a total investment of $50,000. Here's where we're going to figure out our total cash on cash ROI. To figure it out, we're going to take our annual cash flow. To calculate it, we must multiply the monthly cash flow, which is already known, by 12. That's $4,680. To calculate your cash on cash ROI, we will divide our $4,680 total annual cash flow by our total investment. The annual cash flow is $4,680 divided by the total investment of $50,000, or 9.36%. So our cash on cash return of investment is 9.39%. So that's how we analyze a deal using the Foursquare method. We have 4 boxes, 1, 2, 3, and 4, to figure out income, expenses, cash flow, and our cash on cash return on investment. Now the question becomes, and everyone is wondering, is a 9.36% cash on cash return good? Consider the possibility of investing your money in the stock market right now and earning a 20% profit. Regardless of how doubtful it seems, let's presume you can finish it. Consider what 20% in stock returns over a 10-year period would have looked like instead of the current 9%. Well, for the past few years, the average profit on the stock market has been around 6 to 7%, so 9% is still better. Another possibility is if you own a home with significant equity. For that, I like to look at your total return. For example, if the property increased in value by 3% annually over the course of 5 years, we'd sell it. If that occurs, you will earn millions even if you only earn 9.36% per year on this specific property. What more can it be if you have even more properties? Isn't it a great investment? And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.